guys, Scott from Wealth Lab here, Director of Wealth Lab and Financial Planner. In today's episode, we're going to be going through superannuation, how it works, how it saves you money, and what you should be thinking about in retirement. Good episode. Let's get into it. So if you're an Australian in your 50s or 60s, you're not in the build phase from scratch anymore. You're in the accumulation or almost the final accumulation phase of your wealth building journey. So the decisions that you make in that time frame over the next 5 to 10 years will really determine what retirement feels like. So in today's episode, we're going to go through why superannuation is so tax effective, how concessional contributions actually work, what the limits are, what the traps are, and when to make sense of them. So Phil, what's your opinion on it before we get into it?
So it's one of those funny things, like often, like Scott was mentioning, I get a lot of people will say to me, I've invested this money outside of super for whatever reason, insert XYZ conspiracy theory about the government running away with all my money. And sure, I get it. It's a rational thought. It's locked up. Maybe feels like you've got less control. But the reality is, I was just actually talking to a client about this earlier today, but you can invest in almost anything within superannuation. You just need to know how to do it. So you're really not constrained by what you can invest in and what you can't. So that concern about, I don't trust super because it's this mythical bucket that I can't control the investments in. Well, it's not really true. You just need to know where to look and what to do. So realistically, why do we see a lot of people just leaving this like amazing tax effective investment vehicle sitting on the sidelines for what's probably not that, I don't know, irrational concern is the right word, but maybe just not understanding sort of how it all works. So it's not a magical mythical bucket of money that sits there and grows or anything like that. It's literally just a tax structure, no different to you as an individual, a company, a trust, whatever. A superannuation fund is just a tax structure.
Hey, thanks so much for watching this video. Real quick, I've got Jordan, our client liaison manager. He's the one that's going to speak to you if you've got any questions in relation to your financial planning, your superannuation, or just what Wealth Lab helps people with. Book a meeting in the comments below. You'll be able to go straight into his diary. Or if you want to know more, you'll be able to speak to Jordan right here. All right, back to the video. So a lot of people are coming to us in their 50s and 60s and going, well, why do I even need superannuation? I can't even control it. It's just a thing that the government mandated. One of the benefits of superannuation is that it's probably the most tax effective thing you could possibly have. Phil, I don't know what your opinion is on this one, but can you think of anything that's more tax effective than a super fund?
Probably not legally.
Maybe dying?
Yeah, maybe. Even that gets taxed in the wrong circumstances.
No, that's true, exactly, yeah.
Yeah, mate, look, it's definitely, from a tax perspective, very, very difficult to beat for most people.
So just for context, the tax inside a superannuation fund on the earnings is 15%. So if you're earning, say, 45K, you're paying about 32 cents. But if you're earning over 180K, you're paying close to 50% of your income on tax versus 15%. That's like 4 times less tax money held inside super that is in your own name. And that's one of the things we're going to go through today. We're just going to go back to basics, what this structure looks like, how it works, and we will get into it.
For a lot of people, in a lot of circumstances, it's going to be the most powerful investment vehicle you have at your disposal. I don't know if I'm overstating that. I don't think
Big call.
Yeah, well, it's true though. And look, there's a bunch of provisos that come with that. Obviously, as we all know, any money going into superannuation, you can't go and pull it back out again tomorrow. So that's a real concern, and why I say for most people, that's something you got to consider. But if you've got money to invest and it's just part of your retirement bucket and you don't need access to it tomorrow or anything like that, and you can wait till you meet a condition of release, so, turning 60 and retiring or turning 65 or whatever, yeah, you're going to be pretty hard pressed to find a better place for most people to be investing that money.
So Phil, in your eyes, let's go through, what's a concessional contribution? What is it?
Concessional contribution. So you'll hear these terms thrown around a lot, concessional and non-concessional contributions. The simplest way to think of a concessional contribution is anything that's had a concessional rate of tax charged on it. So what I mean by that is anything your employer puts in as part of your superannuation guarantee. So sitting here right now in 2026, your employer should be putting in 12% of your salary as superannuation guarantee. That is a concessional contribution, and it's concessional because your employer's had a tax deduction for it, and you've only been charged 15% tax on that going into your fund instead of your full marginal tax rate, which could be like, 32, 37, 47%, whatever.
Which is interesting because people say, well, hang on, why is this still... So my super... Hang on, I had, $600 went in to my super, but they took $120 out. What's going on here? That's because your employer contributed and then your super fund had to then pay the 15% tax.
Yes, yeah. But it's a concessional rate of tax. So it's a lower rate of tax than you would have paid if it was your marginal tax rate. Hence the name concessional contributions. So anything your employer's putting in, anything you put in as salary sacrifice before tax, pre-tax salary sacrifice would be a concessional contribution. And if you put money in and then later claim a tax deduction on it, so you put that money in, you lodge a form called a notice of intent to claim, tells the super fund you're going to claim a tax deduction, and then you claim that as part of your tax return, that's also a concessional contribution.
So why should we do it? So I'll give you two examples. Like, let's say two engineers, because that's an easy example. Let's say we had two engineers, similar age, similar salaries, similar investments, right? So let's say they're both growth investors. Let's say they both live in, let's say they live in, northern Queensland, for just a random place. One says, I don't like super, I want control. And the other one has leaned into their concessional contributions, both in their late 50s, right? So not the mid 50s, their late 50s. If we fast forward what that person would what those two people would look like 8 years later, and let's say the performance of their portfolios was exactly the same, the fees were the same. The only difference is the tax outcomes. The net benefit is wildly different. One's had an extra 6 figures inside super added purely from their tax efficiency. And Mick will put up the graph here and you'll see those dollars actually look like. But it's exactly the same discipline. They still put money towards an investment account. It still had the same market returns. It's just a different structure, which is that concessional contribution benefit that you get from not receiving money in your own name, putting in the super funds. You're still going to get access. We're all going to turn 65 or 67 or 60 at some stage. That money is going to be there for you, and putting in and utilizing a concessional contribution is a very effective strategy.
Well, yeah, I completely agree. Concessional contributions are insanely tax effective and powerful, because it's not only the tax you save, but it's then the compounding effect on that saved tax as well. It's huge. And if you want to break it down really simply, if I said to you, Scott, I'm going to give you $100 and you've got to give something to the government, would you rather give them $37 or $15?
No, Phil, but I want control over my money.
Sure, take it, but just pay more to the government for your privilege.
I'm just going to stress again that point, which is you really can invest, like it's just a structure. Inside the super environment, you can truly invest in what you want in the same way that you can invest in your own name. So you shouldn't do this, but you can invest in crypto, you can invest in music, you can invest in random abalone schemes if you so choose. Yeah. Don't. No. But you do have that flexibility in both environments.
Dumb stuff with your money, sure.
Yeah.
Just do it tax effectively. Yeah, so it's a hugely powerful strategy, and often we'll get people that are doing that thing that we're all told from the time we're little, pump all your money into paying off your house, pay off your house, clear your debt. It's not always the smartest thing to do.
True. Get advice on that one.
Yeah, 100%. You could be way better off making concessional contributions, save the tax, pay the debt off later out of the saved tax, let the government help foot the bill. But it's a good one to have a chat to us about.
Now, look, I'm going to touch on the carry forward rule, and this is a common one that we see. This is a tactic that we definitely use.
My favourite rule. I love this one.
It's where it gets interesting. So let's say, for example, your balance is under 500K as of from the 1st of July. You need to make sure that it's under that limit. You may be able to use your unused concessional cap, which is just what we were talking about, from the past 5 years to bring some extra contributions forwards in a highly tax-effective manner. So say, for example, for the past 5 years, you contributed $20,000 per annum. You may have roughly a $50,000 unused cap. So you'll be able to use that additional 50K to make some contributions in your fund. You may have also sold an investment property. You may need to realize some capital gains, or your taxable income kicks up. So just instead of straight absorbing that tax hit, you could potentially make a concessional contribution utilizing your bring forward contributions and reducing your taxable income. Phil, got some examples?
Yeah, mate, it's a ripper. I've actually had a couple of really great phone calls this year from clients, and they're always my favourite phone calls. They're like, Phil, what have you done? Something's wrong. I said, what do you mean something's wrong? Just done my tax and I'm getting it all back. I don't have to pay any this year. Not something's wrong. That's what we planned for. So that was the idea. Yeah. It was funny. I've had like 4 of those phone calls this year. So they're always my favourite. But absolute cracker. And that's come about in a few different circumstances. So one of those was a client received a large inheritance, and we needed to find a place to put that money. Now, of course, we would never cook up a strategy purely just to reduce tax. Of course, it's got a benefit of building up your superannuation, but by putting inheritance into superannuation, we were actually able to claim enough of a tax deduction. The client paid no tax for the year. I shouldn't say no tax because you got the 15% contributions tax into super, but drastically reduced, like we're talking tens of thousands of dollars, reduced the tax bill for the year.
I think we've spoken about this before, is like, you don't need to move overseas. You don't need to move to Singapore to pay 15% tax because you've already got that inside your super fund. People are like, we're so highly taxed. Well, yes, if you don't structure your assets appropriately. Yep. And it's not that, like, it's not rocket science. It's a meeting with us. It's a process that you follow. Just don't use ChatGPT, because in preparing for this specific podcast, it came up with a bunch of bum stuff, including rules that were out of date that don't work anymore, as well as it just like blended a few international things together as well. So that was interesting researching this podcast. So be careful about that.
Safe to say our jobs are safe for a while.
Yeah, we're using the robots in as opposed to them replacing us. That's hopefully what happens.
Yeah. So that's a great example, and another one we've used a few times. And Dan touched on this a couple of episodes ago. But really great way to reduce capital gains tax if you've just sold a big asset like a property or shares or something like that. If you've got some carry forward available, then using some of the proceeds from that sale to drop into super and deduct away some of the tax can be a really powerful strategy as well. Yes, you're losing access to that money because it's going into super, but I'd rather it go into super and lose access than go to the government and lose it forever. So
it's in your name. You get some spousal. You got a husband and wife. There's some things you can do there as well. It's a good technique.
Carry forward's a ripper. And just touching on that $500,000 limit. So, you'll see in the rules it'll say you can't use that if your balance was over $500,000. That is at the end of the previous financial year. So just because you cross it at some point during the current financial year, make sure you go back and look at what it was, or if you're working with us, we'll check all that out for you. But don't, we've had clients in the past where they thought they couldn't do it and they actually scraped under by like $500 or $1,000 before the cut-off. So
that's one.
It's worth a check.
So just a quick recap, why super is so tax effective in pension phase, which is the point at which you start taking money out. It is zero tax on earnings and growth, and in your own name. And when you're just in the accumulation phase, it's a flat 15% tax. So that is why it's super effective. We've gone through the concessional contribution limits. We've also gone through how it works. Phil, over to you. What are some traps?
There can be a few traps there, and there's nothing major. It's just making sure you're across the rules and making sure that you've double checked a few sort of things. Yeah, so the first thing to be aware of is just not breaching the cap. Pretty simple one, but you'd think it's pretty simple. There are a few traps in that too, but the cap's $30,000 per person this year. So you want to make sure that if you're doing some salary sacrifice or something like that, that you're actually taking into account your employer's contributions as well and sort of calculating that correctly. So you want to be careful of that. There's the potential to trigger Div 293 tax. So that's a bit of a tricky one. It's not going to catch too many people out, but if your income for Div 293 purposes includes your super contributions, and this is where the trap can be, exceeds $250,000, then you pay an additional 15% tax on the super contributions above that threshold. So if you had a big chunk of money, if your income was $240,000 or something, and then you made a large super contribution, that could push you into Div 293 territory unintentionally.
Well, that's brutal actually, because you actually get sent a bill and you actually have to come up with it with cash after the time. Yeah. So a few months later, you've got to actually put additional money to pay that to the tax office. It's very unfun to pay. And
look, the same with the exceeding the cap. The consequences aren't that dire. But if you go over that 30,000, the ATO is going to come to you and say, hey, you've had a concessional rate of tax of 15% on this. Your tax rate should have been 37% or whatever it should have been, and you need to pay the difference. Maybe you get some general interest charge. So, you don't want to do it if you can avoid it. Not the worst thing in the world, but it's certainly never fun to have to cough up for a bill. And another little tricky one, and this is one to watch out for, and it will get easier as we go to payday super. We've talked about that before. I think it's July this year that should come in, where your super needs to be paid in line with your pay frequency. But at the moment, your employer may be paying your contributions quarterly. They might be reporting them on your pay slip weekly or fortnightly or whatever your pay frequency is, but physically paying them quarterly. The contributions for the quarter aren't due until the month following the end of the quarter. So there is always the risk, if you calculate right up to the 30,000 for a financial year, but then your employer's made the last contribution from the previous financial year in the first month of the new financial year, that you're going to breach the cap inadvertently. So, it shouldn't be able to happen. It's such a dumb thing, but it can happen.
You'd be surprised how often that does happen.
Yeah, it's a really easy one to get caught up on. So,
the fix is just work with your employer to be like, hey, this is what I'm doing, and make sure that the timing works. And they're usually pretty good with that.
Yeah, it's a good one that catches people out, that one. Yeah, no one likes getting mail from the ATO, so do what you can to avoid it.
All right, guys. So look, you're in that final stretch of, say, 55 to 65 in terms of your peak income earning years. This is the time that will make your 65 to, say, 100 a huge difference. Your wealth will dramatically change in this 10-year time bracket for the following 40 plus years. So it's really important that we get it right. It's more about tax efficiency and structure, not about speculating, not about hot tips. If you're looking to us for stock recommendations, we're the wrong guys. The structure the plan, the consistency, asset allocation, these are the things that will move the needle. Lining up out the front of the Sydney Mint or Sydney ABC Bullion will erode your wealth.
And your time.
That's just my view.
You know, there's no secrets here, right? This is not a loophole. It's not some exotic tax dodge, whatever else. These rules are available to all of us, and they're available because the government wants to incentivise you to save your super. So, mate, take advantage of it. You're crazy if you don't. You know, it's an absolute ripper way to be building for your retirement savings and using it with money that would otherwise go to the ATO. So, you know, money for jam if done right.
Thanks, guys. Keep your comments rolling in. We see your comments. We appreciate it. If you've got some questions that you'd like to have answered, jump on the link, book yourself a meeting, and we look forward to speaking with you soon.
Yeah, awesome. Cheers.
Thanks, guys.
Thanks.